Today we have with us a special guest. Special, I say, because he's a regular contributor on Transfin. He's a finance and infrastructure expert who runs an advisory and investment business here in New Delhi. He has over 7 years of experience in investment banking, having worked in Citi and UBS, in London, Tokyo, and Zurich. And he takes a special interest in spotting obvious and not so obvious gaps in India's policy and industrial framework to come up with original investment ideas for his clients. You can read all about him and his awesome articles by clicking the link in the comments section. I'm very happy and pleased to have with us Taponeel Mukherjee, CEO of Development Tracks. Thank you, Taponeel, for being here.
My pleasure.
So let's start with your own personal experience. So when you actually meet your clients, uh, how do you think Indian companies usually finance themselves in terms of their specific projects or in terms of business as usual capital spend?
So, at a very basic level in India, what we've seen is companies finance themselves through equity and debt. So, equity obviously is at a very basic level when you go in the stock market and you issue stocks and shares and you fund that. Second, obviously, is the debt structure, both on the short end, so essentially very short dated borrowing by the companies, and long dated borrowing. What we have slowly started to see is because of the distress that's come into the Indian market, some companies, mainly the larger corporates, have started to look at using their assets on their balance sheet to fund their companies. Essentially, monetizing the value of the assets on the balance sheet and going and generating capital on the back of that.
Right. So like when you say debt, do you mean primarily bank loans, corporate bonds? How do you?
So in India, the focus over the last 2 decades has been bank loans. So primarily the corporate bond market, if you look at it, it's still relatively small as a percentage of the total GDP. So corporates have essentially used the bank loans. And that is something we think is slowly going to change as India moves forward. In the sense, having primarily public sector banks and a few large private sector banks finance these corporates and holding on the risk on their balance sheet is not something that's sustainable from a long-term point of view.
Right. So say if I'm your client and I'm thinking of whether doing a rights issue versus a bond issuance or a bank loan, what would you say are the pros and cons, the considerations I need to keep in mind, for option A versus option B?
So when you look at financing, you're looking primarily at a very basic level of two things. One is what is your cost of funding? Second is how much control are you giving up? So for instance, if I issue equity, I'm diluting a certain stake of mine in the company. But there is a potential that I might raise the funding at a cost which is beneficial for me. Second is I do not have any fixed payments to make in the future. As opposed to when I issue debt, I'm not diluting my stake in the company for a purely simple debt structure, but I'm making the company slightly more rigid because when I get cash flows in the future, I'm going to have to use a certain percentage of that to finance the interest payments and finance the principal payment on my debt.
Right. So in equity, it seems like you might end up you might pay more, but it's a more flexible structure. Whereas in debt, even though cost of funding might be comparatively lower, but it's a much more rigid framework in which you need available cash.
Absolutely. So, as a corporate, you need to look at your balance sheet, your projects, and think in terms of whether this is a high risk project where I can get a big return in somewhere time in the future, but I'm not going to get stable cash flows getting thrown out of the project. In that case, exactly, you go for equity because you don't want to have a very rigid cash flow structure. But on the other hand, if you have a lot of stable assets, you're a utilities company and you're a profitable utilities company, in that case, you can use debt to basically deliver better returns. So it's not that debt is good or bad. It's just that debt needs to be used in the correct way to generate returns and increase value for the company.
So, Tapani, like you so far mentioned equity, debt, either through loans or through corporate bonds, and you also then mentioned some more creative solutions which involves asset optimization. So I want to focus on the third bit because I really don't sense that is the most common option executed by Indian companies. So first part of my question is that why do you think a lot of companies refrain from using these more creative solutions? Are there any factors, or is it like lack of awareness? And like, how do you message that opportunity to them when you talk to them? And secondly is like, let's go into a bit more detail on what those creative options are.
So, Nikhil, when you're looking at asset optimization, what it basically means is when I'm a company and I have certain assets on the balance sheet, I could either go in the market and sell that to someone and rent it back, lease it back, or I could basically go and do an outright sale and raise the money. So you asked an interesting question: is why has not that been done in India yet to the extent that is possible? There's two factors to it. The first is this strategy by Indian corporates has always been looked at as one that should be used when the corporate is distressed. So there are corporates right now, the larger corporates, who have used this strategy to essentially deal with the NPA situation, the non-performing asset situation that they're facing. Second reason is the medium-sized companies haven't been able to do it so far because investment vehicles or structures that would help them do so haven't existed in India so far. Of late, now we've had the investment trusts come in for infrastructure, and we've had REITs come in, real estate investment trusts come in for real estate. That will potentially help medium-sized companies do it. But I think it's very important that people realize that asset monetization or asset recycling, whatever you want to call it, in terms of actually using assets to generate value, is a capital market strategy at par with issuing debt or issuing equity. You could potentially fund your business a lot cheaper and a lot more efficiently using asset recycling. If we look at China, if we look at big businesses out of Hong Kong, we look at the US, people have used these strategies, the likes of Hutchison Whampoa, the likes of Global Logistic Properties, GLP, to actually create tremendous value for the promoter and for the main shareholders.
Right. When you have a company in front of you who has the optionality of either going to the bank or doing like say a sale and lease back, and they have real estate assets accordingly, how does the second option work versus the first?
Sure. So there's two things you look at. First is what is the cost of funding? In a sense, if you were to go and get a bank loan, where do you get that loan? What interest rate? Versus if you had to go and do a sale lease back, what's the effective interest rate that you would pay on that sale lease back?
So by sale lease back, like just to understand, you mean that instead of raising new funds, you take an existing real estate asset, say some piece of land or some property that you have developed, which is non-core to your business. You sell it, get the proceeds, and then to continue using it, you lease it back.
Exactly. So, for instance, if I'm a big hospital chain, I own a lot of real estate because I own a lot of hospitals in prime areas in Delhi, Bombay, Bangalore, Chennai. Then I basically take those hospitals, sell it to a investor, and rent the hospitals back. So that sale of the hospital raises capital for me, raises money for me that I can reinvest into new projects or into my business to improve and grow the business. Second,
So the ongoing cost will be the lease rental.
absolutely, it would be the lease rental, which would be very similar to basically making interest payments and debt. But one has to do the analysis as to whether doing that lease rental payment is potentially cheaper than actually making debt payments. The second aspect to look at is whether running a real estate portfolio is a core area of interest for the company. So, for instance, I might be a hospital business that is very, very good at running hospitals, not necessarily the best at running real estate. The whole idea of asset recycling is that if there is an investor sitting, say, in Singapore, who raises their funding at 5%, and I'm an Indian company and I can go and raise funding at 10%, there is a potential for me to use the investor's balance sheet to monetize my assets and generate return for both of us. because it's much cheaper for that investor to borrow than for me to borrow. And as I said, I can go and focus on my core capability, which is running my specific business.
Currently is the right time to go for this idea of asset optimization? Like, what exactly is the macro driver currently in your view?
So when I look at the biggest macro driver, I think what you've had very, very low global rates for a long time. And you have a lot of investment capital sitting in the developed economies, such as Europe, Japan, US, that needs to get invested into high quality assets globally. Now, India presents one of the most compelling investment opportunities in the emerging markets. There's a lot of interest around investing in India. So if I am a corporate and I hold high quality assets, it's a great chance for me to essentially go and monetize the asset because there's that kind of capital that is interested in that asset. What that also lets me do, as I said, is gives me a lot of flexibility in my balance sheet to take that capital and start looking at investing it into new different strategies. So that is the biggest global driver for me.
Right. Both in the developed markets as well as in India, demand is picking up, inflationary trends are on its way up, so everybody expects rates to go much tighter going forward. So how do you see that playing out with the timing point that you made earlier?
So just to go back a bit on the discussion, I think what's important is to have creativity around your capital structure. So as you said correctly, rates in the developed economies, specifically in the US, are expected to go up this year. And it's important as a corporate to realize that given where rates are, this is a fantastic opportunity not just monetize assets, but also start looking at the balance sheet from other perspectives. For instance, if I have borrowed a lot on floating interest rate loans, this might be a good time to switch into fixed interest rate loans, which is basically locking in the interest rates. Second aspect would be, as a corporate, if I have to finance a lot of long-dated projects, this might be a very good time to actually borrow for longer. Because as rates start going up, which are expected to in the next few years, it will be much more expensive for me to borrow longer. So maybe if I borrow for 10 years now, and I can use that capital, and I think there is good opportunity for me to borrow for 20 years, then one should do that.
Well, Taponeel, thank you so much for talking to us. It's been great having you.
Thank you so much.
Thank you. The journey to raise capital starts by taking a hard look at your own business. Do you have any assets which are non-core and can be monetized? How sure are you about the stability of your future earnings? Are there any market risks that might change that stability? Are you paying too much interest in a low rate environment? Answers to these hard questions is perhaps the only way to best determine an appropriate capital structure for your business. As Taponeel rightly pointed out, there are many creative solutions out there, but picking the wrong one can spell disaster, and picking the right one can add tremendous value to all stakeholders. Hope you enjoyed this video. Please comment and subscribe to Transfin for receiving rich original news content from the world of business, finance, technology, and our economy. Have a great day.